Most people will spend 40 years working and end up with almost nothing to show for it. Not because they didn't earn enough money, not because they were lazy or unlucky, but because nobody ever sat them down and explained the rules of the game. Today, that changes. I'm going to walk you through the fundamental financial concepts that separate people who build real wealth from people who just get by.
And I promise you, once you understand these ideas, you will never look at money the same way again. Let's start with the single most powerful concept in all of personal finance: compound interest. Albert Einstein reportedly called it the eighth wonder of the world. And whether he actually said that or not, the sentiment is absolutely correct. Compound interest is what happens when your money earns returns, and then those returns start earning returns themselves. It sounds simple, but the math gets extraordinary over time. If you invest $1,000 at 10% annually, after 1 year you have $1,100. But after 30 years, you have over $164,000. So 30 years of investing $1,000 means you've invested only $30,000. The remaining $134,000 comes from simple compounding. You did nothing extra. The money just kept multiplying on itself. The lesson here is not just that compounding works, it is that time is the most valuable ingredient. Every year you delay investing is not just a year of missed gains, it is a year of missed compounding. Starting early is not just good advice, it is mathematically life-changing.
Now, here is something that trips people up constantly: the difference between an asset and a liability. This sounds basic, but most adults have it completely backwards in practice. I actually didn't learn this until my late 30s. An asset is something that puts money into your pocket. A liability is something that takes money out. Your investment portfolio is an asset. Your mortgage on a home you live in is technically a liability because it costs you money every month. Understanding this distinction changes how you evaluate every financial decision you make. Before you spend money on anything significant, ask yourself one question: is this putting money into my future or taking it away? Let's talk about diversification, because this is where a lot of new investors make a critical mistake. They find something that seems like a sure thing and put everything into it. Diversification is the practice of spreading your money across different types of investments so that when one area underperforms, you are not devastated. Stocks, bonds, real estate, index funds, different sectors, and different geographies. The whole point is that not everything crashes at the same time. Diversification does not guarantee profits, but it dramatically reduces the risk of catastrophic loss. Think of it as the seatbelt of investing. You hope you never need it, but you are glad it is there.
Now we need to talk about risk and return, because these two things are permanently connected. Every investment comes with a relationship between how much risk you take and how much return you can potentially receive. Low risk investments like government bonds offer lower returns. High risk investments like individual stocks or startup companies offer the possibility of higher returns, but also the possibility of major losses. Understanding your personal risk tolerance is crucial. This is not just about personality. It is about your age, your income stability, your financial goals, and your timeline. A 25-year-old has decades to recover from losses. A 60-year-old does not have that luxury. Your investment strategy should reflect your actual life situation, not just your best case scenario fantasy. Here is a concept that does not get nearly enough attention: inflation. Right now, as you are watching this video, inflation is quietly destroying the purchasing power of any money you are not investing. Official government statistics say inflation is running only around 3%, but reality shows it's at least 8 to 10% or even more. Regardless, even if inflation runs at only 3% annually and your savings account is paying you 1%, you are losing ground every single year. This means doing nothing with your money is not actually safe. It is a guaranteed slow loss. Investing is not gambling. Staying on the sidelines is the real gamble. Understanding inflation reframes the entire investing conversation. You are not choosing between risk and safety. You are choosing between different types of risk. Now let's discuss liquidity, which is how quickly and easily you can convert an investment into cash without losing significant value. Cash is perfectly liquid. Real estate is not. Some investments lock your money up for years, others can be sold in seconds. You need a healthy balance of liquidity in your overall financial picture. Financial advisors often recommend keeping 3 to 6 months of living expenses in a highly liquid emergency fund before you start investing aggressively. This is not being overly cautious. This is strategic. If an emergency forces you to sell investments at the wrong moment, you could lock in massive losses that take years to recover from. Now let's get into something that genuinely excites me: dollar cost averaging. This is the strategy of investing a fixed amount of money at regular intervals, regardless of what the market is doing. Instead of trying to time the market perfectly, which even professional fund managers consistently fail to do, you just keep investing steadily. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this averages out your cost and removes the emotional decision making that destroys most amateur investors. You stop trying to predict the future and start building wealth systematically. The last concept I want to leave you with is the most psychological one: delayed gratification. Every dollar you spend today is a dollar that cannot compound for your future. This does not mean living miserably. It means being intentional. The people who retire wealthy are not always the ones who earn the most. They are the ones who consistently chose their future self over their present impulses. That is a mindset shift, and it is arguably more important than any technical financial knowledge.
Here is the truth that nobody wants to hear, but everybody needs. Financial literacy is not taught in most schools. The system was not designed to make you wealthy, it was designed to make you a consumer. But now you have these foundational concepts that will help you succeed: compound interest, assets versus liabilities, diversification, risk and return, inflation, liquidity, dollar cost averaging, and delayed gratification. These are your tools. If you want to go deeper on any of these topics, drop it in the comments below and I will cover it in the next video. Your financial future starts with what you do today.